This is Justin Pulitzer. This is my weekend review video for Monday, July 4th. Happy birthday, America. Lot to cover, gonna jump right in. So I've discussed how I think the Fed is pretty much off the table for a while. We've gone from pricing in potential rate hikes to now pricing in potential rate cuts. Wow, have the tides have turned. Anyhow, let's get into the 6 market keys. We have been now kind of brushing past the 7 Fed keys until I think the Fed is going to be more back in play. So let's start with the VIX. I have discussed that I think that we could potentially be in one of these kind of sedate volatility periods where you get these momentary spikes on fear. No different. We all know we got the Brexit, and of course the Brexit was supposed to be the end of the world. What I think really happened here was just the market didn't position properly for it, and that's why people got very nervous. It was sort of a done deal that it wasn't going to happen, and it did happen. Meanwhile, after all that fear, I will show you we've taken back basically the entire Brexit move, and the Brits, who were supposed to be, in dire straits, the FTSE is at 10-month highs. I don't really cover foreign markets in that regard, so I'm not going to get too into it, but I will discuss the U.S. Anyway, we did have that close over the 25.20, and it was basically a look above and fail, and we closed basically, that was the high, and we've just sold off completely into the end of the week and back below the potential old potential reversal to uptrend line. We are coming back down into the lower end of the VIX range, so you probably want to be a little bit more cautious. This is now purely directional play with options. You meaning, buy calls, buy call spreads, or buy puts and buy put spreads. We don't really like to start selling premium until we start getting into the more elevated levels. Anyhow, I hope people took advantage of this and did a little bit of premium selling. I know I did. I discussed a little bit of it on the stream. But let's get into some markets here. Anyway, with quick thing with the VIX, wouldn't surprise me if there is any selling this week, if there is some kind of a pop back up to retest the backside of the channel. If not, we could even come back down to the lower end of range, but granted we are in the mid of the range there. We want to be a little bit more cautious with selling premium. It's more purely directional play here. The dollar, so we had this big run up. I talk about this range that we're in. It's really, we got back basically to the middle of the range, which I had discussed. The 200 MA, we met some resistance, and we are kind of just chopping around inside the lower part of that range. I wouldn't say there's really that much to get too concerned about until the dollar really starts clearing the 200 MA and the 25.23. Here we're probably going to have a 100 MA test. We'll see how that plays out. I think that the likelihood of rate hikes are low. You do have some intervening in some of these foreign countries with their central banks. We all know China is devaluing. Whenever there's fear of recession or big displacements in currency, the dollar is kind of where that money flows. I'll even one-up you on that. I think that the reason the dollar has remained bid for a while is this flight to treasuries. We all know that Europe has moved into negative interest rates, so I believe there's a bit of an arbitrage to be had there. They either sell or get out of those European bonds, and they put the money here. I mean, even if you're getting 1 or 2%, when people get a little nervous, they don't necessarily worry about a return on their capital. They just worry about a return of their capital. And the Treasury market is deep and liquid, and so is the U.S. currency, that they could kind of get in and out of it without their buying or selling impacting the market. But I do think that there's so much of it going on that people are selling their currency to buy dollars, and then they buy the treasuries. So we'll keep an eye on this. We are making some higher lows, although this kind of is a bit of a violation. But if you kind of X this out, you are making some higher highs off higher lows, so we have to be a little bit cautious with the dollar. It is doing what it should be doing, coming back to the mid-end of the range. It is possible we get to the lower end of the range, but I usually like playing this more on the extremes, kind of playing for a bounce down below and then kind of selling it when we get the rally back up. So we're going to keep an eye on this swing high. If this gets taken, I think there'll be some more fear about recession talk and that kind of stuff, and there could be a move back up to the upper end of the range. So just keep an eye on this. Mid-range here is a point to be a little bit more careful, particularly with the 100 MA. Snap there, I think we do get the retest of the lower end of the range. If this holds and we do take this, then we could get a little bit some more Momo to the upside there with the dollar. Speaking of the dollar, gold, oil, lots of commodities are priced in dollars. You can see there's a bit of a breakout we're seeing in. I don't even need this anymore. I mean, this was a big reversal day that I had discussed was a good place to take profits. We got the 50 MA test. The 50 MA seems to be holding, and we're rallying a bit. You got a 5-day consolidation, and then Friday was a gap and go out of range. I want to show you something on a bit of a longer time frame, 10 years weekly. You can see this has been in a persistent down channel. We could be coming up to the upper end of this recent up channel and the primary down channel up around the 133s. So I would be looking for, and you can see there were some past tops and some past supports here. I would be an interested right or right out short for a move into this region. I do think it's going to probably rally more to get there. So in the current phrase, I like it as a long, although I don't love it as much as lower channel tests. But it seems pretty strong considering this couldn't even pull back to the lower channel. And we are, basically in an uptrend within an up channel. So I do think that there is a move coming to this area. I don't know what, if this is going to back and fill a little or chop sideways, but I do think that there is going to be a grind up here. So that probably augurs poorly for the dollar and more positive for the precious metals. Silver is the way I've been playing this bad boy, and holy wow. If many of you watch me, and I know some of you do pay attention to some of the stuff I say on occasion. You know that I say that silver often leads gold. And in this case, you can see that silver is busting out of the channel. I do think that this is getting a little bit parabolic. I talked about booking some profits here. I guess it's turned out to be a little bit of a rank conservatism. I had thought just since we came up basically from close enough for government work channel low to the channel high, there could be a little bit of listing and pullback, but instead it decided to go through. Let's do 5-year weekly. You can see that there is quite a bit of, there's a little bit more room up to the 200 MA, 200 period moving average on the weekly chart. You can see that's really where this broke down from, so it wouldn't surprise me if there was a little bit of short-term resistance here, but the Fibonacci levels and the real breakdown levels don't come into play until like the 25s, 26s. That's where the 38.2 is, and if you get up to the real volume distribution is 30. I do think that that's coming in a longer time period. Like if you look at this is forming a really nice rounded bottom. So I do think that the path of least resistance is higher for silver, but I do think it's getting a little bit ahead of itself. I'd be more inclined for risk-reward purposes to kind of reload on dips rather than chasing the rallies. So I'd be looking to take some profits short-term on some pops in silver and then looking to buy the dips. That's just the way my mind works, and I think that that will be the correct way to be playing these metals over time. I had talked about the bonds. I guess I was a bit of a tease there in the sense that I didn't really, I talked about it with the dollar and I didn't show the chart, but let's talk about that. We all know the bonds are key. They made a new high here. In terms of context, the way I like to display this is this way. You can see that 2009, everyone, the end of the world was taking place, 2008, 2009. This was the 2000, the financial crisis. And we are really quite above those highs, and even the debt ceiling fiasco, the recent run-ups. So this is, to me, is all money flowing into the U.S., chasing yield here because there is none in Europe. As far as this goes, this has run a lot fast. You did have a lot of consolidation here, and it's been a bit of a runner. So people get nervous when you start getting these kind of parabolic moves in the bonds, for the reason that they start thinking that there's a recession. But I think that it's sort of the Fed isn't going to raise, so it's kind of the only game in town are bonds and stocks. And I tell you this, people are often baffled at why the market, the S&P in particular, can be trading so expensively, right? We know earnings estimates are coming down. We know growth is slowing. We know the global economy is anything but strong. We've been suffering quite a few terror attacks. We know the Brexit is not, situation happened. That's not because things are going well over in Europe. It's because they're going badly, and you have very high unemployment rates. I went to a friend of mine's wedding in Italy a couple of summers ago, and I could just feel the recession there. You could feel the unemployment. You could see the graffiti on the walls in Rome, and it just didn't feel like a city that was thriving. I mean, they're so backward in terms of their technology too. Like, you can go into a taxi cab, and some of them have meters, some of them don't. They don't take credit cards for a lot of things. It's still largely a cash economy. There's no Walgreens in the sense, or Dwayne Reed's that we've become accustomed to. Like, if you want to go and buy something, you go into a pharmacia, and it's a small little mom and pop shop, and you ask, and they basically take it out from behind the counter and show it to you. So these economies have a lot of modernization to go, but that's neither here nor there. It's just basically that the world is not doing well, and as long as you have a lower for longer, and I'm even adjusting that to now to lower for even longer, because we know the Fed is kind of out of the picture, and growth has been slowing, that stocks, even with their meager earnings or slowing earnings or what have you, are still the only game in town really to get a yield. I mean, look at like the Philip Morrises of the world and so on and so forth. I don't want to get into those charts too much here because the video will be longer than I want it to be. But that basically has been commanding a PE multiple premium. Everyone who's like, stocks can't be 19 times earnings. I've heard some people say it's 20 times. I think we're somewhere between 17 and 19 times earnings. I'm comfortable with that number. Everyone always likes to say that the proper PE multiple for the stock market is 15 times earnings. That's actually completely incorrect. The market tends to vacillate in cycles between 10 times earnings to 20 times earnings. And I think people are thinking we are up to the upper end of the range. The only problem is that when the market tends to peak with the PE multiple premium, interest rates are usually about 6%. That's what happened in 1929. That's what happened in 2000 and again in 2007, although the housing market back then peaked in 2005. I don't want to get into the reasons for that. If anyone's interested, just leave some comments. I could dedicate some time in Periscope to go over that. That would actually be a perfect place for that if people are interested. But as long as stocks are valued based on a discounted cash flow model, which is DCF for short, the discount factor that is the proper one to use is known as the weighted average cost of capital, WACC, if you want to Google it. I have a link to a great description from NYU in the description below, and you can play around with that and see how that impacts on valuation. And anyone who's trained to be an analyst, a financial analyst, or who's done any valuation knows that interest rate sensitivity is very important. And as interest rates are plunging, as bonds are rallying, you're getting a multiple premium with a low interest rate environment. We can't even hold 2% on the 10-year. We're at 1.46 or something, I believe, in the 10-year. And you have a 17 to 19 multiple in the S&P 500, far from the 6% where people say, listen, things are getting loftily expensive. We don't want to pay up for earnings, and we can get a risk-free return of 5-6% in bonds. Usually when you look at healthy stocks, right, that pay have heavy dividends, you usually look for somewhere between 4 and 6%, right? 5 being the sweet spot. So if you can get that and not have to really risk your capital, wealthy people aren't necessarily always looking to grow their capital. They're looking to preserve it and have their bills paid if you've kind of made it in life, and they put their money into the bonds. But here, the bonds are so low, they're forced to put their money into stocks, and that's hence why the market is staying quite high, because it is commanding a PE multiple premium. So I hope that explained things. Anyhow, we are getting a little bit excited with the bonds. You can see I drew in a channel. We have traded on the upside of that channel, but it did hold here the last time. I might have to redraw this at some point, but we are getting kind of lofty into the upper end of that channel. I'd be looking for some kind of right or right out short action up toward the upper end of that channel for a bit of a pullback, one of these types of moves. I don't necessarily think that the bond market is going to fall apart until the Fed really starts getting jiggy, but volume is rising here, and we are getting into the upper end of the range. A lot of people don't really know how to use volume properly. I'm going to go off on a little bit of a tangent here because I think it'll be very helpful and illuminating to people. A lot of technicians say that they like to see high volume in moves to confirm the move. And when I start seeing stocks moving, or bonds or whatever in this case, moving up quite strongly and the volume is increasing, to me that's not necessarily quote-unquote confirming action, meaning that there will be still higher prices. Yes, in the short term there may be, but to me that means the move is kind of getting long in the tooth. It means the trade is getting crowded. The same thing to the downside. If there's huge spikes down and there's huge spikes in volume, it means that everyone has kind of already done the selling and that there might not be that much more to go. So just think about that in volume. I kind of have a bit of a counter consensus view on volume. I think that, believe it or not, could be the most important thing I talked about in this entire video. So just keep that in mind with volume, that it's often signaling kind of, getting closer to the ends of moves. You can see like this was starting to get a bit parabolic here. There was a little bit more up after these moves, but it did signal that there was a move back lower. What you'll want to see is that spike in volume, and then see the volume kind of really either explode or contract, and then you'll kind of you'll get an idea of where things are peaking out. So that's a bit of a different way to use volume. One of the things that had me not so afraid of the Brexit was HYG. You can see this was what was leading up into the fear of the rate hike, and that was also when oil was really kind of blowing up. I think that's really what this was. Fear of all these oil companies that kind of borrowed to drill and to do projects, and when oil rallied, the fear of those bankruptcies subsided. You did have some of them, but it wasn't like en masse. And you can see this was the all the Brexit move. We basically just got down to the 200 MA. You can see up here, 200 MA was a lot of resistance. This was the first time we broke out, and now we're just consolidating around it a little bit. So it doesn't seem like we have a bit of a credit crisis. When markets peak, it usually tends to coincide with a contraction in the credit market. And that's because a lot of people, own stocks on margin or are forced sellers. If you can have credit and you can carry positions, you're not necessarily a forced seller. So keep that in mind also for market tops. What I talked about with the P multiple premium being given because interest rates are historically low. And then for the real problems to start, you need to start seeing what led up to the Lehman Brothers when credit started contracting. I don't want to get into LIBOR premiums and so on and so forth, which is really when the day of reckoning is kind of at hand. When I start seeing those types of things, I will be more inclined to talk about them. But for now, I don't want to really waste too much airtime. What I want to stress is that we are kind of consolidating and kind of chugging a little bit higher. Here you did make a bit of a lower low, but you did hold some important moving averages. You can see the 100 here was a little resistance, it then supported. Here it's kind of coinciding with the 100 and 200. So I'd say the HYG is kind of quote-unquote okay until you see a break there. That to me would get me a little bit more concerned, thinking maybe it's the early warning signs of something. And considering that that's the kind of the triangle, you see rallied here, it basically filled up the triangle, overshot maybe a smidge, and then, basically back up, back on trend, This I don't even like using as a trend line. I could say that this is a kind of a short-term, it's not an official regression line, but for me it connects some lows, and you can see that we're basically riding along that line. So maybe moves below become buys, and then moves above maybe become a little bit more, you want to be trimming profits. Keep it simple. What else? So there's a lot of talk about the banks. I want to talk about this briefly. It's not something I cover very often, but the banks are still in a downtrend. You can see. I know that a lot of people are trying to kind of pick the bottom. The problem with banks is they've been regulated. They're basically utilities. They've been kind of neutered. They can't make the kind of money that they used to. So they had been in a bit of an uptrend, and now they kind of are slipping back into a bit of a downtrend. If you see, we did have a bit of a inverse head and shoulders bottom that did resolve higher, but it did resolve right to trend. This had a bit of a tumble here, basically to retest the inverse head and shoulder breakout. Didn't quite get the full 61.8, which is what I was kind of a little bit waiting for. It stopped ahead of there, and now we're rallied back up. Keep an eye on the 200. That's where this stall happened before the big meltdown. I don't like it as long as it's kind of on the wrong side of the 200 MA. Back above, I think it gets a bit better, but I really would feel more comfortable seeing a trend line break for a rally, to be quite up. If it does it right here, I don't expect it to, but if it did do it right here, be a little wary because it's kind of coming up from the bottom. It's already moved quite a bit. Those are often a lot of head fakes. Like, you'll have a breakout, but people won't realize that it already rallied back up from basically a lower end of a range, and it's kind of an opportunity more to sell than to buy. If this were to rally up here, consolidate sideways for a couple of weeks, and then go, yeah, that I would really be digging. With regard to these stocks, the one I've been using as my proxy is this Morgan Stanley. I drew in a neckline here around 26.16. That's really not an exact number. I just kind of thought it was good because I think I drew it in here when we bounced here, and then that was the high for the moment, and we came down, and then it kind of is just struggled around that area. Same stuff is going on here. Let me zoom in a little bit more. 50 MA kind of rejected. The neckline kind of rejected. This closed a little bit weaker. I guess you could use this range here as a right or right out play. Anything above 26.40 probably will rally still more to the downtrend line for the full gap fill here. A move lower, I think will probably want to come back down maybe into these 24s area. That's just kind of my feel. Cheap stock, I mean, these are all trading at single-digit PEs. I mean, if you can stomach holding these for a few years and you put them in like a dividend reinvestment program, DRIP, and these things are yielding 3, 4, 5%, if you want to buy them on pukes and you have a longer-term perspective, at some point interest rates will go up and these companies will be able to start making some money. They'll learn to love again, but until there's really a new president or a new set of regulations, it just seems like these guys are all going to be struggling to make money. I mean, look at Goldman Sachs. This is kind of the pride and joy of Wall Street. You had a head and shoulders top, a breakdown, a check back that didn't even quite make it. It kind of made it to the lowest end of there. Another breakdown. You basically have a double bottom here, and you rallied back up. I'm very wary of this stock as long as it's below 148.62 to 151.65. Again, not a really expensive stock. I don't necessarily know if I'd want to be shorting this. You really wanted to be more short on the break of the neckline. Now it's kind of just chopping around. Yeah, I mean, you had a primary trend touch. This was a good right or right out area with the double bottom. So We're going to have to see how this plays out, if this breaks the downtrend line. If it does break this one, it probably could make it up to here. But my guess is it would probably be a more of a right or right out short opportunity based on how it got there. If it were to rally up hard there, again, remember what I said about coming up from the bottom into the top of a recent range. You have a 200 MA, which is really where this party got started on this breakdown. You had the kind of false look above, and then it's never looked back. It's due for a 200 MA test, but I think that it would be a good right or right out short. If this were to pull back, if you're long, 143.53, this low here is really, you kind of got to hold it. It's this reference low and basically the body here. Anything below there, I think, is probably short. Just my 2 cents on Goldman Sachs. What are some other ones that people love? JP Morgan, that's one that's probably the best of the best, right? This now has a bit of a head and shoulders. It didn't really fully form the right shoulder. Instead, it just kind of puked it down. If you're long, I guess anything above 60.59 to me is still kind of quote-unquote okay. I was really looking for a move to retest kind of the diamond low and these reference lows. I think it would hold. But we are still making lower highs and I guess equal to lower lows. I'm a little wary about these stocks with interest rates going lower. These banks, all they do is, basically charge fees. More of it is moving online, so the fees are becoming less. And a lot of banking is basically moving into digitization, so there's less and less opportunity to kind of knock people over the head. And without interest rates rising, banks are really not making a lot of money. I mean, they're issuing loans, 30-year loans for like 3-4%. I mean, there's not a lot to be made there. So you really need rates to rise for these companies to make a lot of money. Are you going to get killed owning the banks? I think on down moves, you can buy them. I might start accumulating a few, when they yield 4 or 5%. Premier names like JP Morgan, eventually, maybe my grandkids will make some money on these stocks. One thing I did find interesting, and I mentioned it in real time on the Twitter stream, was the curious case of Deutsche Bank. Starting to sound like a STD almost, right? Deutsche Bank, how this thing trades. Anyway, I wanted to show you, I was a seller up here. It wound up being quite prescient. And I'm out. But I did add in a position back, a tester back here, and I'll show you why. Brexit, this thing collapsed. Everyone got nervous. It rallied back up. It came back down, but look, higher low than the move with Brexit, and then it moved up a little bit higher. I still think this thing is a little bit vulnerable. European banks have NERP, which is negative interest rates, which is even worse than zero interest rates. This thing could easily come back down and, test lower. If you were to lose these two lows, I would take my right or right out long play, flatten it, and probably put on a right or right out short play with put spreads or ratios for a move down to the lower end of the channel. That being said, we are in the less steep channel, and it already is kissing those lows. That's also why I tried the right or right out play. You had a higher low off the channel low, so at the very least, maybe we do make a move back to the middle point of the channel, to maybe to the 16s. That to me would be an interesting point to maybe book a little bit of the profits. I am a trader. So these lows key. If not, we see these lows. The channel lows, and if these hold, then I think we could see midpoint in the channel. So that's my view on the Deutsche Bank. My favorite of all of the financials, if you must be an owner of financials, are the insurance companies. These companies, if rates rise, don't have the same type of regulations the banks do and will be making money like Al Capone. That is the truth. Look at this. You had a consolidation, higher lows in a channel up, and you had basically a gap and go professional gap. And I love when I see things like this, although I wish it was sort of after this day instead of this day. where you have a consolidation day that basically closed near the highs. I think that this thing is going to work itself up over time to the channel high. Just seems like the way we're going to be working it. You can see here you've had a lot of resistance in this area, and it seems to have really cleared. If there was some kind of a gift back down to retest the backside of this breakout, I would be a right or right out buyer on the gap fill and the retest here. I don't necessarily think that's going to happen, but hey, sometimes life happens. Expect the unexpected, right? That's like a good Roadhouse comment. I'm going to talk about that a little bit more when we get into SPY, but it seems to me like Travelers wants to play to move a little bit higher. A big key for the market has been crude oil. This was kind of the culprit which led, remember, the decline in the HYG. They roughly bottomed out around the same time. The backside of the old uptrend line was 49s. We are basically holding the 50 MA here. You had a bit of a secure low light, like I like to call them. Secure low to me is like one of these jobs where this is actually exactly a secure low. Look at this. You have a low, excess low, bookended here. This excess low bookended by two higher lows and a move up. When you come down and then down again and rally, to me it's a secure low light, meaning this is the real secure low, and then this is kind of the light beer version. It's not quite the as potent, as powerful, but it often does have a bit of a play. So as far as if we can hold 49s and clear 50s, then I think we're going to start filling this gap up here to the 56s. And maybe get up to the 58s. If we lose the 50 MA and these double lows here in the 45s again, then I think we're going to see 42s and 41s maybe with the quickness. So that's my view on oil. My better ways of playing oil, if you're not a futures trader, is with the XLF, which we talked about, the 200 MA. Look where this breakdown really took place. This is for the first time in like a couple of years. We've been back over the 200 MA, and this is starting to look like low, lower low, higher lows, kind of maybe forming that rounded bottom. These can also be, if oil rises, big dividend players, the companies that participate in here. I have a bit of a mini regression line drawn in here. 50 MA to me is really key. If we lose the 50 again, then I do think we will get the 200 test and maybe even some of these Fibonacci levels. But if this can just keep riding higher, I think it'll start developing more of a following, and it might start getting some higher prices. So that's my view. It's 50 MA, above the 50 MA, higher, below the 50 MA, a little bit more suspect. The people who know me best know about my sort of affinity for ExxonMobil. This is in a big up channel with a mini channel and kind of its own kind of regression line in and to itself. It wouldn't surprise me if there's a little bit of resistance coming up soon between here and the up channel, which is like 96s to 97s. I think everyone's going to kind of think it's going to 100. I do too at some point, but there could be some premature selling. It depends where it is. If we just got to go sideways for a while and then it works its way up, it could just ride the channel high. You could see it kind of did that here for a while. It had the break below. This was like a look below and fail of the 50 MA, and it's back up. I mean, this thing is just, I mean, look at this, 52-week highs here on Fridays. Exxon, to me, I talked about buying it down here. Wow, did that work out? I sure hope you guys caught it. And now this thing is just back up. It's just beast mode. Exxon is the best balance sheet. They are known for increasing and raising dividends and buying back stock, and it's just the best of breed company. It's always over time one of the best performers in the S&P as far as dividend stocks go since way back. If you would have bought this stock back in like the 2002 to 2003, you'd be quite happy. Once in a while, you get some pukage with Exxon. In these periods is when you want to kind of load the boat. So I'm still bullish on Exxon, but I do think it's going to be time to maybe start booking some profits as we get into the channel top and some of these past reference areas close to a hundo. The Chinese, they are the future, right? They're the country, the Chinese and India, right? They're the growers. I don't know what that makes us, but I do know that the 200 MA here on FXI has been hard to sustain. We're back above it. It really needs to hold. This to me looks like we're coming to a point of resolution, in the coming months. We're making higher lows and basically equal to, I'll just call them equal highs because this is kind of flat. If this can punch out, then I think this could rally quite a bit. It would be the opposite of filling up the triangle to the downside. It could fill up the wedge to the upside, maybe even up to 40. If this bullish pattern, or a lot of people say the rising wedge is a little bit of a bearish pattern. I mean, I don't like to judge. I don't like to judge. Anyway, sorry, I like my own humor. We are breaking the downtrend here a little bit. We're in a bit of an up channel. It could see the upper ends, as it grinds higher. If this were to lose the channel low, though, at this point, this to me would be a debacle and probably would see the lower end of range rather quickly. So again, be prepared for, be down for whatever. This was the old uptrend line. We could come into there, somewhere between there and the channel high, I think would be a great place for right or right out shorts, considering their big reference levels. If you want to play long, the call spreads aren't super duper expensive. I like it that way. One of the things that has me a little bit hopeful, and anytime you're hopeful with this stock, you probably need to have your head examined. There should be like Alibaba's Anonymous for people who have tried to play this stock from either side, really. But this is just consolidating here. Look what it did here, and when it broke out of the pattern, it got really fugly. Keep an eye on this. If it breaks out to the upside, I think it'll get jiggy back up to $100. I do think at some point this stock will see 100 again. If this were to break these lows, I think we will see the channel low again, maybe quicker than people think. 77.77 to 75.01ish is really the those are the big levels. If you're in this late, you have a 50 MA, you have a 20 and a 10 MA here. Below there, you probably could play very short-term put spreads for a move to range low. If we can get back up above 79.68 and then 81.27, this probably is where you want to book some profits. Keep in mind you came from the lower end to the up here. But if this can really go, maybe this time is a little bit different. I don't really like to play BABA, but I know a lot of people are interested. So, hey, I aim to please. IBB, this to me looks like this could have been a bit of a look below and fail here. Look how many days you came down here. I think a lot of people just puked it up here. You had the move below the range, and they hadn't realized that you were basically into these reference lows, and it had already come down so far so fast. Back above the wedge, really got to stay above this trend line. Back below here to me would get real nasty quick, particularly if you gave up this entire up day. Then I think you'd really get it, but because you'd have come down, made the low, bounced, and then probably could resume down. If this does hold, though, this day in particular, particularly half of this day's range here, the 258s, let's say, then I think we could maybe see the upper end of the range. That being said, it's all caveated that we're below the 271.77 to 275.40. Proceed with caution. 50 MA could be the end there. Another look below and fail was Gilead. Let's talk about that. Everyone kind of wants to know about this stock, right? You had the breakdown. I talked about being out when I saw this. You came down. Now you had this look below and fail, and we're still below the 50 MA and still below the 84.88. So I wouldn't say that it's out of the woods. It's just a little bit better than it was. There's a gap fill and a 50 MA here. That's probably where you want to book some profits. If you want to try a right or right out short, that's all right. But I'm kind of starting to think that this might have been a false breakdown. This stock is so cheap. It trades at like 7 times or 8 times earnings. We all know they have to do some kind of an acquisition. My only issue with this stock is that and industries is when they have these kind of peak earnings, when regulations are coming in, they all look cheap, but they're really not. And those multiples go up as their profit margins go down. So just be careful with these. These are all piñatas during the election season. One I've been playing, I'm actually long this GlaxoSmithKline. This to me looks like it's trying to form a bit of a rounded bottom. I like that we were in this consolidation area and it broke out. I'll use this as my stop. Anything below 42.45, that to me would be kind of a false dawn. Somewhere between there and the 50 MA to me are the must holds. There's some room though to the upper end of the range and to these reference highs. This is like a 5% or something dividend. I like that. This is a bit of a longer term play for me. It's not one I'm really looking to boot around too much, but I'm a trader and I always have my discipline. So if the breakout were to fail, I would be less inclined to be involved with the stock. But that's one that I've been kind of playing. Another one I like is this ALKS. I had played this before earnings, took profits, and I've been back and forth in it for a while. This to me, again, a bit of a look below and fail. 50 MA to me is the must here. I like that we're punching back into the channel. If we were to lose these 3 days, basically had these consolidation days. I always love these days, long above them or short below them. This was a punch above. I think that this wants to fill this gap at some point, somewhere to the 53s to 60s. But 50 MA to me is really the key. You can see once it broke above it, it's been the support. The bit of a false breakdown, now back above it. Any closes below the 50, and we will be outie 5,000. All right, so with regard to the S&P 500, remember in the past weeks I talked about a narrow window for a decline? Well, that narrow window turned out to be Brexit. So, like I said, you got to be ready to sometimes expect the unexpected. This week we're only supposed to have about a $2.64 move with 4 DTE. We know today's the holiday. That would take us to a high of basically the range highs here of 212.56 based off on the Friday close, or 207.28 would be kind of the lower end here, kind of back down here. All right, so what is my take on this Brexit? I'm gonna use this the levels here to really explain what I think and kind of the context and the way to look at. You had multiple days of consolidation here, and this was a big capitulation day in the sense that a lot of the move happened late in the day and even was higher after hours. I think this sucked in a lot of late longs, and the fact that we did get the Brexit and people were disappointed and not positioned properly because I think they were just playing for the inevitable pop up, had to kind of puke out positions. And my theory here is that this was a bit of I thought this was going to be a bit of a sell the news anyway, to be quite frankly, just the way it closed. If there was no Brexit, I think that it could have been a small move up, or probably I thought that this day would be a 210 pin with Brexit, believe it or not. Look where we pinned on Friday. Basically there. So I think that this was just a very large liquidation break. And in bear markets, what you'll get is a big liquidation break that doesn't recover. This did recover, but you'll get this big move down, sideways consolidation, resolving lower, consolidation, resolving lower. If it's quick and it recovers quick, equally as quick, and I said if you went out for a cigarette break, you missed the Brexit decline. 2 days is not a bear market. It rallied back. Prices were not comfortable down here. It rallied back higher. We also had, and I discussed this, the end of the quarter. I said that in the last weekend's video that I wasn't 100% sure how this was going to play out, but I thought we would see recovery. But again, I always say expect the unexpected. If you're, it's also possible that there wouldn't be. We were near a range low. It made sense that there was a recovery. We are back into some key levels. I've added in this 211 as a range high, this 208.97 to 211. because that has been the areas that have been tough. We are still in a bit of a decline, a bit of a, I wouldn't even really say a decline, but making a little bit lower highs. Friday we weren't able to close above there. I think that really had to do with the pin. RTH was 209.92. SPY trades for 15 minutes past the close, as do their options, and it basically pinned 210. So that shouldn't really be too much of a surprise for anyone. If there is a decline now, if there was to be, this were to kind of be the top, like we come in next week and the end of the quarter window dressing, and and we had the first day of the quarter, and people decide, hey, when in doubt, palms out. The key levels to me here again are going to be the same ones as before. The first of all, 210 is important. This gap is for the most part filled. It wasn't 100%, but we are well into that day's range and body, so that gap is considered filled in my book. 208.54 to 208.97, those are the key initial levels. I want to show you why quickly. I took out the ovals because I didn't want it to be confusing. This was the mini failed wimpy head and shoulders, as I've referred to as before, as opposed to maybe the potential real one that we're setting up here, although I'm less inclined to think that. I'll talk about in a minute. I don't know that we are, and I don't know that we aren't. I just need to see a few things. Look here. This was the failed right shoulder. So the high there was 208.54. Any price level above there that negated the head and shoulders remains bullish. So that is my real line in the sand, the failed right shoulder high. If we can remain above there, I will remain more bullish. You have a 50 MA below here into 207s. That would be basically the test if we were to come down. The price level to me of the $2.64 seems a little sedate. I think that if we rally, it's likely that that's the extent of the rally higher. If we came down, it might be more. But I am using these levels. If we were to come down somewhere, I would give a little leeway to the 50 MA because, look, this is where the support was, and only when that really gave did we get the bad move, the big bad move. We just came through that 50 MA so hard without really any pause that it wouldn't surprise me to see a retest. It could also rally higher with us. But to me, it seems like the all-time highs could still potentially be in play. Clearly we have to take that potential head and shoulders off the table. It's not fully yet. I know a lot of people are anticipating that that's going to be the case. I've had a lot of people question me on it. It just seems to me that a lot of these are very visual things, and a lot of people are still very bearish. The same people who were bearish all throughout this area were bearish here, are still bearish here. It's not a euphoric market. That's one of the things that still has me thinking that all-time highs could be in play. Just the fact that we've also been up here so many times. You knock on a door enough times, maybe it enters. And the fact that we had, the look below, really, this range, the 204s, the 202s, back to the lower end of the range. We're back up here so fast. It just seems to me like it's very highly likely for the head and shoulders to play out if this were to get bearish. This didn't have a chance to really build out. You can see how this spent a lot of time building out this sort of left shoulder. This needs some time to build out, in my view. It's not going to just be we came back up here and we fall apart again. That's not really my view of how this would play out. It would be that you need to spend a lot of time here, then come kind of work your way back down here slowly. And then I think if you lost the 202s again, the 204s and 202s, and challenged back below this Brexit bar low, then I think you would get quite a powerful move lower. I don't want to get too anticipatory. A lot of people get very excited with anticipating stuff. Again, I'm just using I'm using the key levels for me are these. This day was the Yellen day when she flipped from rate hikes to being more dovish. That's 205 quarter and 208.54. This is sort of the lower end. This is the must-hold area for me for the bulls. Below there at this point would be below the channel low and we basically would have given back most of this, all of this up move. This to me would be very bearish below there. This hold is key. If it can hold there, I think that it's still kind of quote unquote okay. But these are my two levels that I'm really watching: the 208.54 to 205.25. Anything above there to me remains. Anything above this to me remains more bullish. Below becomes a little iffy. Below this gets real iffy. So let's keep it simple. If we can punch through 211s here to the channel high, good area to take some profits because we'd have come up from the bottom. Remember what I said? We're not likely to just kind of soar through. Although if we are going to get one of those blow-off moves, that would be how it would happen. It would be, up, up, and away, and then, kind of coming back down. Like, that would be the move. But this would be the area where I'd be looking to book some more profits. Into here was a spot, and then up into here a little bit. So if you are one of the people who think this is going to form the head and shoulders, it needs some time to build out. Very simple. The bad news for you with that, though, is if it does spend some time building out here, it works off the excess really from the move up. This was terribly poor structure coming down, clearly poor structure coming up. When you're in school and your teacher tells you bad behavior doesn't warrant bad behavior, shouldn't be met with bad behavior. But in this case, bad behavior was met with bad behavior, and maybe it cancels itself out. The more time it spends up here to me, above the 208.54 and the 208.97, the more chances to me that it works off the excess, and then we do get a move to all-time highs. If we start listing lower and breaking down and getting below 205.25, then I think things are going to be not so pretty. Any key ES level I don't want to show on the chart right now is 208.98. That was the neckline really before the breakdown. North of there is good. South of there is a little less good. IWM. Look at where this decline brought this to. You had an old down channel, and we just retested the equal low, basically still actually a little bit of a higher low, and the back side of the channel, and now rallied back up. That is actually kind of bullish price action. And we are still within the box. This box, to me, is really very key. We are in it. As long as we're in it to win it, right? 114.29. Above, to me, still remains more bullish. That's now also the roughly, you have a 50 MA right below, and you have some range lows there. So let's say 114.29 down to 113.38. Above there, to me, remains still bullish. Below gets iffy. If you can break this downtrend and go still higher, I think we could see the 120 area again. That, to me, is my view in IWM. The Qs. This is the least bullish of the lot. We all know why, right? The weakness we've seen in Apple and Google and so on and so forth. Bit of a regression line I've drawn in there. We're on the right side of it. We are below the up channel. We basically rallied back to it. This also has me a little bit concerned that we basically filled this gap. We're back to it. Let's use the 250 MAs here as the key. If we stay above, I'll be thinking more bullish. If we get back below, I will be thinking less bullish. The real key is the 204 to 205 level. If we were to lose that again, I don't think the market would take too kindly to that. I think we could move down to retest these lows. That is the key. So the first levels here are the 50 and 200 MAs. Those are 107.44. That's the 50, so, and the low of that day. So let's use that, the 50. So 107.44 plus to me remains bullish. Below is a little bit more iffy. Keep it simple, stupid. Apple. So I was noticing something in Apple this week. I had talked about a write-out trade that wound up working out quite well. Bit of a secure low play here. Also right on the 92 level, and I said above the 2-day high here. This at the time wasn't, these were I think roughly equal. I don't remember where the trigger was, but above there I thought would see the gap fill. We got it. We got right to the 50 and 20. So it's showtime. 197.69 to 196. I'm sorry, 196. 96.69 to 96.10. This is the key area. If it can't get above, we'll probably come back down. If it can get above, it will probably see the 100 and maybe the 103s again. If it rallies hard into their earnings, it's probably a right or right out short. If it comes down hard into the earnings, it's probably a right or right out long. I would love personally, because I'm no longer involved with Apple, long or short, I would like to see it sell off on this earnings, to have one last flush, get out all the hope and Warren Buffett is long and all that nonsense, get the flush, and then set up well for the winter, for the fourth quarter. The iPhone 7 is coming out, the Watch 2, which I think is going to do a lot better than people think. That's just my view. So this is going to be a Costanza, I think, to do the opposite. If we fill this gap ahead of the number, then I think it will likely be a row short. The options will likely be cheap if it rallies. If it comes down and gets expensive, then I would be more inclined to play a bit long. Facebook did exactly what it was supposed to do. Came down to the channel low, got the gap fill, talked about buying it, secure low play, rallied back up. As long as it's below 116.23, it still does remain a little bit vulnerable, but they do have earnings coming up, and they tend to do well on their earnings, so maybe there is a rally higher. I'll probably be a Costanza play with this also. I really want to see where it is. If it's just chopping, or if it rallies, or if it does sell off, it's going to matter how I play it. So I'll review Facebook when we get a little bit closer, but the play here was long here. It wound up working, and let's keep it simple. For further, could use this 2-day range. If it loses there, you might get a little bit of a pullback. If it goes over, you'll probably see the 50 and maybe even the channel high. Keep it simple. Amazon, I'm running a little low on time, so I'm going to try and go through some of these quickly. Somebody forgot to tell Amazon that there was a sell-off. It basically had this mini look below channel, still held the 50 MA, held the 684.82, and basically about to make new all-time highs. Not a seasonally great time for Amazon, but could see the channel high. This stock is just they're killing it, man. They're taking market share. They are slaying it. That's just my take. These aren't really, there's no excess here. There's no poor highs. It seems to me like this probably is going to go, it's probably going to go higher. Netflix had some news. They're coming up into some important levels. Just watch the downtrend. I think that this could be at least for a day trade, a good right or right out short. But I'm bullish on Netflix longer term. It just doesn't tend to do great in the summer. That's just my seasonal experience with this stock. A bit of a look below and fail, because we were here before. It is a secure low, but a secure low light, and it's bouncing back up. This probably gets a little bit more love ahead of the number, and then I actually would prefer if this thing really dumped hard on their number to be a right or right out play, but who knows, maybe it fills the gap. We'll see where it is right before the number. We still have a little bit of runway between here and there, and where it is will matter. Google coming down, had a look below and fail. This is a reversal bar, right? A morning star, whatever kind of bar, and it's rallying back up. It would not surprise me to see Google rally ahead of their earnings and then maybe sell off. This doesn't tend to be the best quarter for Google historically. That's just my view. Again, I've traded Google in the summer and I've seen how it plays. I ideally would have liked this to come down to the channel low in the primary trend line to set up for a right or right out long. I don't like to play it intermediately, but this is a reversal bar. Probably has a little bit more into it, but I am going to keep my powder dry until their earnings and discuss. Tesla, holy cow! Back to the secondary, right? We're back above 215. The 61.8 here held, basically just shy of the channel low. Still making lower highs and lower lows. I think a puncture, the best thing this thing could do here is do some consolidation and then go. And then I think you're off to the races for the summer. I don't think that this is necessarily a story of the stock. I don't want to get into this. To me, it doesn't matter. These guys could be making buggy whips. The story is that, they're an exciting story. They have a high consolidated ownership, poorly distributed stock, and a high short interest, and that is still the case. Watch for the pattern to shift for a trend line break, and that to me will be the signal to buy. Right now, this here was the spot. If you missed it, you missed it. Sorry, but you need to now see a downtrend break. If you can't wait, 215 and above is long, below is a little iffy. Secondary price does matter. Price line, this was way too much, way too fast, and she broke the channel, got down to, I don't know, between fibs. I was actually hoping for a full gap fill. So far, we didn't get the wish. I could see this rallying back to the backside of the downtrend line and this low, and then this could be, to me, a good right or right out, just right or right out short test. We'll see how that plays. 200 MA is a key level. It's resisted twice, so let's keep it simple for a quick trade. Below Friday's low, could try right or right out short. Above the 2-day high, right or right out long. In between, we don't touch. And if the trade triggers, it is literally right or right out. If you want to give it a little bit more runway, halfway between the bars would be the stop on the trigger of either way. Anyway, that's my story. I'm sticking to it. I did want to cover some more, but we're already over an hour. If you're not following me on Twitter, my handle is @JustinPulitzer. If you like this video, hit the thumbs up. I always appreciate when people leave comments as well. Please subscribe to the channel. You will get notifications when I post new videos. These, Periscope rebroadcasts, and special edition videos. Anyway, let's enjoy the rest of our July 4th. Happy birthday, the USA. And we'll have a great abbreviated trading week. Cheers.